this episode, I discuss how Silicon Valley Bank collapsed, and I also answer the question, could something similar happen to mutual life insurance companies? I'll also detail important lessons for all of us to learn in light of the recent bank meltdowns. I'm Nate, and I make sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. Well, everyone, another one bites the dust. We have just experienced two of the biggest bank meltdowns since the last financial crisis in 08-09 with Silicon Valley Bank, SVB, and also Signature Bank collapsing recently. Us in the infinite banking concept cult, us IBC Kool-Aid drinkers, we get a little giddy when things like this happen. Maybe we shouldn't. It's probably not fair. But anytime you see turmoil in the banking world, it just shines a spotlight on the becoming your own banker strategy. Because the issues that caused the bank failures and all of this concern in the banking world are unlikely to happen in the world of becoming your own banker using dividend-paying whole life insurance policies with mutual life insurance companies. And so I want to detail that. I want to detail what exactly caused Silicon Valley Bank and Signature Bank to fail. A common question we've gotten is, well, how are insurance companies doing? Are they exposed to the same risks that Silicon Valley Bank was? So I'll describe that too. I'm already kind of playing the hand, but you'll understand why it makes a lot of sense that they're not in just a minute. And then, of course, I'm going to talk about what lessons can we learn from these collapses. How can you watch Silicon Valley Bank collapse based on a certain subset of risks that they weren't aware of, and then how that may impact your own life and how you should make your own decisions in light of these types of things happening. I feel like I'm a broken record, though, because in all of these last 10 episodes, I'm saying almost the same things. I don't mean to. I'm just merely saying there's just all these signals are starting to create clicks of pieces together in my mind that I used to not even understand at all. And I'm becoming more confident than I've ever been of the power of becoming your own banker. I've been doing this for 11 years, and I have never even been close to being as confident as I am now that becoming your banker offers unique power and potential that you cannot find with almost any other investment strategy, financial strategy, whatever it is that is out there. It is a unique thing that you ought to learn about, and it is not pitching a product. It is pitching an idea with the principles that you can live your life around that can insulate you from these types of things and protect you from these types of things, of course, while also helping you make a ton of money at the same time, which puts it in a unique position. And so I'm becoming more and more in love with it. I hope you are as you listen. So let's go ahead and dive into the first point. What caused Silicon Valley Bank and Signature Bank to collapse? You know, a lot of us think that banks would collapse because they've made bad loans. I think in our own mind's eye, if you go back to the Depression, if you go back to the housing crisis and the financial crisis that occurred, a lot of them were collapsing because of non-performing loans, creating a shock to the system. So we would think that Silicon Valley Bank collapsed because of bad loans. But lo and behold, they did not collapse because of non-performing loans. So Silicon Valley Bank collapsed because of a unique set of financial risks the banking world didn't even really realize fully was going to happen. So this is how it worked. Silicon Valley Bank, and we've talked about this many times, how banks operate. Anytime you make a deposit to the bank, it is a liability to the bank. Legally, a loan, you become a creditor of the bank. And so most of the bank's money that they use to make loans and do all the things that they want to do is money that's left there by depositors. And when banks get pretty large, it actually can be difficult for Silicon Valley Bank themselves to find individual borrowers for this money. So it's not uncommon for someone like Silicon Valley Bank to choose to take all of this money that their depositors are leaving there and then invest it in different types of lending instruments. It could be U.S. Treasuries. Like, it's not going to be non-performing in any way. It's going to be a very performing loan when you're making a loan to the U.S. Treasury. It's supposed to be a risk-free idea. So here's what's funny about this whole situation that I'm about to unveil. Silicon Valley Bank probably thought life was great. They're not even taking a lot of risk in their own mind. They got a ton of money stuck in U.S. Treasuries. Here is where the risk unveiled itself, though. So Silicon Valley Bank, in this tech glut, doubled in size, or maybe tripled in size in the last 5 years or so, from the amount of deposits they'd received. And they would take those deposits and go put it into very safe, in their mind, instruments. The problem was that now all of those tech companies that used to be bringing capital in and leaving it in deposit at the bank, now they are actually under financial duress. They're losing money and they're not raising capital anymore. So they're actually spending down their deposits. They're having to spend down their deposits to make payroll and all sorts of things because the money's not flowing freely anymore. So now Silicon Valley Bank is losing money that used to be in deposits. No big deal, by the way, if you are properly liquid as a bank. Here's where it starts to get dicey. They had all of this money tied up in 3-year, 5-year, 10-year treasuries back when interest rates were very low and they were desperate. They were stretching for yield. They were stretching for a rate of return. Banks love it that we will bring them deposits. Back in 2019, 2020, when interest rates were nothing, they were receiving deposits at 0.5% from us depositors, and they were taking those deposits and buying 10-year treasuries at 3.5%, whatever it was at the time. That is a huge margin for a no-risk situation. At least they thought it was no risk. This is why we're trying to tell everybody the banking world is not fair. It is not set up to benefit you. They are making money off of us like crazy. Here's where the risk was, though. The bond market is kind of counterintuitive. It's very interesting. If you own a bond that you bought, you put money in, it's a 10-year bond, and it's paying you 3%, if the interest rate environment in the bond world changes, instead of buying putting money in 3% bonds, now people can find 5% bonds, 5.5%, 6% bonds. What that does is it dries up the liquidity of the bond market for previous bondholders. Essentially, that's what it's doing. So in other words, if you put $1 billion into a 3% U.S. Treasury, but now the U.S. Treasury is offering 5% 10-year notes, who's going to buy your stupid 3% bonds? Nobody in their right mind is going to give you $1 billion to take over your place in that bond note when they could just go put their $1 billion into a brand new U.S. Treasury at 5%. So what does that mean? It means that the value, the actual purchase price, the sellable price of that bond goes down now. If it was 3% when you bought it and you want to get rid of it, you need liquidity now. Here we go. Silicon Valley Bank is losing depositors. They got all of this money that was brought in by depositors in 2017, 2018, 2019, 2020, 2021. Life was looking great. They were taking very, very cheap money from depositors and walking over to U.S. Treasuries, buying 5-year treasuries, 10-year treasuries, all sorts of things. And then suddenly an interest rate spike occurred out of nowhere. An interest rate spike occurs out of nowhere, and the value of those bonds, if they were to sell them, they are now going to get less money than what the face value of the bond is. If they own $100 billion worth of bonds that are 5-year, 10-year, now if they were to sell them, maybe they'd only get $80 billion. This creates a problem. Now, it's only a problem if they have to sell the bonds. Now, listen to this. So they are hoping to find liquidity from somewhere. They start seeing their deposit base start dwindling down, and then the warning signs start to pop up like, oh my gosh, we have all of this very safe assets. Our loans are performing. But if the depositors keep depleting their accounts and we have to get money to give to the depositors, we're going to have to start selling these bonds. If we start selling these bonds, we will find out that we have less money than we owe depositors. We're going to go bankrupt. So they're hoping to raise some capital, but then word got out that they're trying to raise capital. And suddenly, oh my gosh, now the world knows that if these deposits keep dwindling down, the bank is going to have some serious financial problems. And that, of course, is just gasoline to the fire. Once word starts to get out, then everybody's texting everybody like, get the heck out of Silicon Valley Bank. They may end up collapsing because their bond portfolio, the capital that it's worth now, because they don't have any of the new debt. They only have the old debt that's low interest. If they have to sell those to create liquidity, they are going to have some serious problems. And so then that's when all hell broke loose, because now everybody's walking in desperately trying to sell off their assets. They didn't have enough money on hand, liquidity, so they would have to start selling, and they would have to sell at losses, and it was just a matter of time before it was imploding. That's when the FDIC and the U.S. Treasury walk on in and take over the bank. Banks and other companies start to produce fragility in their life. The ability for these types of meltdowns start to occur whenever they stretch for yields. And the same thing is going to happen to you. I want to get into that here in a minute. That anytime we're desperately searching and stretching to earn higher rates of return, you better watch out. Because there is some under the floorboards fragility that you may not even be aware of, that all it takes is a shock to the system and the whole house of cards falls. And that's what Silicon Valley Bank was doing. It was taking short-term demand notes, and they were turning around and locking it up in longer term debt, which created this difference that could become an issue. So of course, some of you listening to this would be like, well, Nate, don't insurance companies do a lot of bonds as well? And that's exactly right. They absolutely do. But the question is, why are mutual life insurance companies insulated from similar things like this happening? What is their real exposure to this? Remember, the only real problem, the only real issue that Silicon Valley Bank and others like it would end up having issues with is if their liquidity dried up and they had to start selling assets at a loss in order to get liquidity. The reason that this is very different than mutual life insurance companies is because mutual life insurance companies never sell their bonds. They take their money, they buy long-term debt, and they don't sell the debt. So then you would ask, well, how do they have liquidity? They are just incredibly safe, secure entities that are federally regulated to have a far higher level of in-house liquidity than banks do because of the amount of death benefit payouts that have to occur anyway. So they are extremely liquid overall for what they actually need. On top of that, the big issue with the banks is there's no requirement for depositors to continue to deposit money at the bank, right? But the nice thing about insurance is that there are premiums. And so there's a cash flow that all of the people who are pooling money together in the world of insurance are sending money to the insurance company every year in the form of premium. Or at least the vast majority of them are, of course. Now there's some, of course, that will do premium offset or something like that in the future. But in other words, there's just a steady flow of cash flow in. There's a steady flow of cash flow out in the death benefits. It's all actuarially built out. So the bit of a difference for insurance companies compared to like Silicon Valley Bank is based on the fact that insurance companies are always going into longer term instruments and they never sell them. In other words, it's like a recycling thing always happening. Like in other words, they own bonds they bought 30 years ago that the principal is being paid back this year and then it's going to be reinvested into new bonds this year. And then next year's the same. It's simply a cycle of bonds that are coming liquid every year. There's always a ton of principal being paid back in from the bonds they owned 20, 30 years ago, and it's being reinvested on top of the constant flow of premium amounts that everyone's paying into policies to keep them in force and so forth. So the insurance is far more insulated from this type of event ever happening. Silicon Valley Bank was very unique in this collapse, but it all stemmed from them choosing to make a decision to take long-term or to take short-term demand notes, like checking account deposits, and put them to work in 5-10 years down the road. If you are to do that, you have to be aware, if you're a bank, that if there's a financial downturn, these deposit wells may dry up, and then we're going to have to sell those bonds to produce liquidity. I'm just trying to say the insurance companies never have to do that. They've never once had to do that. There's no reason to think that they would right now. Their business models are far different. They don't have checking accounts. Banks don't like these types of changes because they're not built this way. They don't like drastic movements up and down. They really don't. In times of higher interest rates, they can make a bit more money sometimes, but they got to pay their depositors more. They would rather just be consistent. Insurance companies would love for interest rates to go back up to a higher amount. They're just going to produce more profit overall.
Is the money in your bank account losing value instead of growing? Are inflation and taxes going to get better or worse? Conventional banking makes the bank rich using your money and pays you little to nothing in return. We believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to beat the banks and inflation. Visit livingwealth.com/beatinflation. You'll receive instant access to what we call the beginner's course. This in-depth and easy-to-follow course teaches people how to create and profit from infinite banking. You can become debt-free, in control, and achieve financial security and significance. Stop letting the banks and Wall Street dictate your financial future. Go to livingwealth.com/beatinflation today to instantly receive free, no-obligation access to this priceless course on infinite banking. Again, that's livingwealth.com/beatinflation. Now back to Nate and Holly.
All of this to say, you'll notice there's going to be differences about mutual life insurance companies and why they just so rarely, if ever, have financial difficulties the way that like a stock-held company was. Number one, anytime an organization is stretching for yield as opposed to preserving capital as its primary function, you're going to create fragilities. And this is the issue. Any stock-held insurance company or bank, all of them are forced by the design of capitalism, and I'm not opposed to it. I'm just merely saying they are desperately striving for yield. They are desperately stretching for yield. It's a gamble. They think if it works out, like Silicon Valley Bank, they were making a ton of money for the last 5 years, taking deposits from us and then going out and buying 2-year, 5-year, 10-year U.S. treasuries and pocketing the huge difference. It was an amazing business. They were having so much fun doing it. Who would have ever thought that you could go bankrupt buying U.S. treasuries? Only when something like this happened. There was an unknown risk that occurred because they were stretching for yield in an unwise way. Mutual life insurance companies do not stretch for yields. Their number one focus in life is preservation of capital. That's always been the case, and that always will be. That's why insurance is not flashy. You wouldn't want it to be flashy because you don't want the company to stretch for yields. This is one of the reasons why we don't think universal life policies, IUL policies, can work, because essentially what the insurance companies are saying when they do the index universal life and other types of universal life is they're saying, we want to be able to stretch for some yields on these policies, but we don't want to take on any sort of risk if the stretching doesn't occur well. So that's why they control every facet of the policy, and they guarantee that they will be profitable on those policies, even if there is a shock to the system, by their contractual right to decrease cap rates and increase cost at their whim. It was essentially like saying, hey, it may work out for you, or if there's a shock to the system, if it doesn't really work out well, then we're going to increase the cost, the fees involved, and we're going to decrease the cap rates, the participation ratios, and you're left with whatever's left. But hey, if everything is super rosy, then maybe it'll work out pretty well for the policyholders. All that to say, I'm not a huge fan of UL policies. You might buy one, it may work out for you. That just like it might have worked out for Silicon Valley Bank to keep buying longer-term U.S. treasuries with short-term demand notes. It might have, if everything works well. The problem is it creates fragility. Anytime you add fragility to your financial life, rates of return go out the window. Man, the rate of return for Silicon Valley Bank had to be incredible. They were able to borrow billions of dollars from depositors at a 0.5% interest cost and buy 3% U.S. treasuries, 2.5%. It doesn't even matter what it was. The rate of return was unbelievable. Rates of return are great when everything works out great, but understand if there's underlying fragility. That does bring us to lessons that we can learn, really, from the Silicon Valley Bank collapsing. And really what you'll find is exactly what we've been mentioning in a few ways for individuals. We've mentioned this idea of sequence of return risk. This is the same idea that doomed Silicon Valley Bank can doom people in retirement. It doesn't actually matter the average rate of return of a portfolio when you're in a distribution phase of life. If things don't turn out well in just a couple of years, the sequence of returns don't work out well, you could lose everything. This is one of the things we do in the beginner's course. We mentioned this in one of the episodes about, how IBC can help you retire. Is that the idea behind the sequence of return risk is that the best period to be in the market was from about 1970 to 1999. It's the best 30-year period in the market. The market average, the S&P 500 with dividends averaged like 14% or something like that. Of course, right before you hit the dot-com bubble. Right before it all, exploded. But between 1970 and 1999, best 30-year period in the market history, if you were to have $1 million in 1970, you could have lived off $100,000 a year, 10% withdrawal rate. 10%, just pull out $100,000 every year, 10% of it, and you could have lived for the next 30 years with the average rate of return of 14% going the entire time. You would have been a perfectly fine individual. If you just simply flip over the returns, then actually what you can create in that same window of time is you'll run out of money in 14 years. Now, it's the same average rate of return over 30 years, just the sequence was different. And that's exactly what the Silicon Valley Bank ran into. The sequence of returns created a liquidity crisis that required them to sell at a loss and essentially ended up bankrupting the company. What IBC is putting forth to the world, that the world is finally awakening to, thanks to podcasts like this, the power of liquidity has to be mentioned somewhere inside of someone's financial position. Liquidity, by the way, so having a whole bunch of money in policies, having it grow by 4 to 5% tax-free with no risk, it's not bad. It's great. I love it. But what I'm saying is people always say, well, can't I get a higher rate of return doing X? Or here's one thing I want to note. Just please listen to this. Liquidity looks bad when everything is going well, but it looks amazing when shocks to the system occur, when black swan events arrive out of nowhere. I have worked with hundreds, if not thousands of clients over the last 11 years. I have heard many stories of financial success, and I've heard many stories of financial failure. All of the financial failures are occurring because people were not properly capitalized. And that seems like a dumb moment. If you have enough liquidity, when crap hits the fan, if you have cash, money, liquidity, there is nothing to worry about. The problem with SVB, Silicon Valley Bank, is they did not have enough liquidity at the moment they needed it. And the same thing happens to us. If you don't have enough liquidity backing up your enterprises, backing up your investment portfolios, backing up your real estate investments, your business, whatever it is, then if there's a shock to the system, you will probably lose a ton of money. It's better to live life with the idea of fragility and anti-fragility than rates of return and not rates of return. So many, especially in the real estate world, are doing the same things that people were doing back before the last housing crisis. They're putting minimum down payments down, borrowing 80% or more of the purchase price of an asset, and it's going to look great on paper, and the rates of return are going to be amazing, unless there's a shock to the system. I actually was listening to a real estate podcast that hosted one of the guys on the Bigger Pockets podcast. And he mentioned this exact same thing. When interest rates started to go up and some real estate values were going down, he was the one who was mentioning, it is true, if you don't have any capital, any liquid money as a backstop to things, then that's actually when it gets dangerous. I'm not that worried about short-term movements, if rents goes down or if the property prices go down. I'm not that concerned by it right now because I'm sitting on over $1 million in liquid cash. My question to the audience: would the rates of return of his investment portfolio look better if he took that $1 million and bought more properties? And the answer is yes. But could he lose everything if he did it that way? The answer is also yes. What I'm trying to say is rates of return can be very deceiving when you build your life on it, which is why I've loved the book Anti-Fragility, because he's trying to say build your life on becoming anti-fragile, achieving high rates of return without betting your entire life on the success of whatever it is that you're betting on. Have liquid capital. We're going to do a podcast that's going to launch, I think, on the next episode or two, 176 or 177, that describes just that. The barbell approach to investing. And so I think you're going to really enjoy what the barbell approach to investing really means. People stretching themselves to find yields always add fragility because of what they're doing. My suggestion to everyone out here is don't be like Silicon Valley Bank. Don't make your number one priority high rates of return, stretching, desperate for them. Understand that you can stretch if you want. Make sure there's a proper backstop to this, and we believe that infinite banking is the best solution for this that exists. The idea of becoming your own banker is the best solution to create a capital system that is the safest, most secure, most consistent thing that exists. Whole life insurance, the most consistent thing that's ever existed. Build up your liquid capital in there and use that leverage from that position to take advantage of the investment opportunities and other things of life that are going to require liquidity, so you never run into a liquidity crisis. Understand that while rates of return and financial freedom sooner rather than later is extremely important, you can overstretch yourself when you're so desperate for yield that you could create some problems if you don't also focus on having adequate liquid reserves that back up all of the investments that you're making. That's why I think banking is so important. And don't build this up in an SVB, Silicon Valley Bank. Don't produce your liquid capital like everyone else in a bank account. The same thing that's going to happen. I'm not even talking about the bank failure anymore. I'm just merely saying they will take your money at 0.5% and go buy U.S. Treasuries at 2.5%, 3%, and they'll pocket the rest. Why do we do this to ourselves? Why do we allow ourselves to be taken advantage of? I don't know. It exists in the banking world. It doesn't have to. You can become your own banker. You can own the institution and profit from the entire process of banking through dividend-paying whole life insurance issued by mutual companies. And then you can use it wisely as a capital buffer for any sort of issues that may come your way in the investment world. And you can leverage the cash values in the policies to even make the investments themselves and create a truly anti-fragile, highly profitable financial system where you can make a ton of money when things are going good, and you have enough capital to preserve all of the investments you make when things go bad. And so you can create a very low risk, high return lifestyle through infinite banking. I really believe that. Well, everyone, I hope this was an enjoyable show to you. I do expect, more possible bank failures to come, but I don't think it's going to be a huge issue unless crap hits the fan, folks. Unless we have some more black swan events, then tighten the belt loops, because who knows what's going to happen if loans start to become non-performing on top of these interest rate changes. That could cause some problems. Might as well get out now. Come join us over in Dividend Paying Whole Life, mutual life insurance companies practicing the becoming your own banker process. Become your own banker. Don't worry about it anymore. You'll be glad that you did. Thank you guys so much for coming. This has been Dollars and Nonsense. If you follow the herd, you will be slaughtered.
One last thing before you go. Start your journey towards financial security and wealth today. Visit livingwealth.com/beatinflation. You'll gain instant free access to the beginner's course Ray, Nate, and Holly made just for you. Again, that's livingwealth.com/beatinflation.